Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Elisa, thanks for taking some time to join me on the show today. I really appreciate it.
Thanks, Owen. Great to be here.
Yeah, it's always a bit of fun when I get to chat to someone who works at Magellan, because I think that the fabric in which the kind of process is stitched is really interesting, and it really resonates with the way that I invest. And today we're going to be talking about payments companies. We're going to be talking about high quality investing and what that truly means. And we might tie it off with some risk around that as well. But normally I'd start the show with some icebreaker questions. I've got them actually at the back end of the show, so I'm eager to get to those. But the thing that I really want to jump into in the first instance is this idea of quality investing and the way you do that as it relates to payments companies. Now, I'm fascinated by this, like electronic, digital payments, all of it. I love it. So I am hoping that we can go on a bit of an exploration and just explore why payments companies fit within that criteria of quality as you define it. And then maybe we'll go back and forth from there.
Yeah, absolutely. I love talking about payments. I've been at Magellan for coming on 8 years now, and I started covering payments 2 to 3 years ago, and it's just been so interesting, like the web that payments are. Yeah, we'll have a great chat today. So I might just start at the beginning on, like you mentioned, Magellan and quality. So I think it's important to really just kind of set the scene on what quality is and why it's important. Quality is a term that gets a little overused maybe in investing. So I think it's really important to focus on, well, what is the definition of quality? And then on the flip side is, how is that definition implemented? Because that practice part at Magellan, it's something that is really important to us. And hopefully you'll see today why that's the case. So when you're thinking about quality, you can have a standard definition. So the more kind of quant index approach, where they're just looking at historical data, be it ROE, return on equity, or stable earnings, or leverage. Now, this is data is important. We need to look at the past, but in isolation, it can be a little bit backward looking. And something that you might find interesting here is Coinbase actually did make a quality index. Now, some people do view crypto assets as something to invest in, but when we put our Magellan lens on, we don't view that to be quality. And a big part of that is because we're always looking at the future. And when we look at the future, we find it hard to look at a crypto asset and think, okay, well, this is a quality industry, because we don't know where that's heading. That crypto assets, they're not currently being regulated. What are their competitive advantages? So really hard to tell. So when we put our definition, our hat on Magellan and what's important, there are many things that we're looking at, and that's really the Magellan DNA. So those that have followed Magellan for a while, you've probably heard some of this, but it's really important to keep refreshing it, I think. So what we're really looking for is those unique attributes that enable a company to sustainably earn attractive returns over the future. So the difference here, we're not just using that historical data, we're looking at the industry structure, we're looking at the company and thinking, well, how will that perform as we go through time? What are the competitive forces? So some of the factors that we're looking at are their moat, which we'll talk about in a little bit. What's their trend? It's the business risk, agency risk, and then those ESG risks and opportunities. So we're asking ourselves these questions of, what are the barriers to entry? What does competition look like? What's the industry structure? Do they have scale? So these are really important questions that we're asking ourselves to do that deep dive research. And then we have our investment committee oversight. But hopefully when you get the sense of those questions we've just mentioned, you can't just go to a data source for that. You actually need to get into the weeds. You're looking at annual reports, you're talking to industry experts, we're debating it internally, because there's no simple answer to what makes a quality company. Now, there's lots to unpack here, but I think what's actually really important is, well, why should you actually care as an investor? Right? We've just, like, we mentioned the word a lot on quality, but there's, like, why do you actually want to be invested in a quality company? And when we're thinking about quality and why is it that we spend so much time defining what quality is, it's because in our world, we view there's 3 factors and reasons why that you should be looking at the underlying quality attributes of a company. So the first one is that you have greater conviction on the sustainability of the earnings for that company in itself. Now, I think it's always good to just reflect on yourself and work out, well, like, what does that actually mean? So I imagine most people listening, you either have car insurance or maybe home insurance. That's giving you certainty about your cash flows. So then when you think about that company example, if we can have conviction in cash flows of a business, that gives us greater certainty, and we're happy to pay more for that, and that should be generating us value. Second principle as to why we think quality is important is that quality companies, their earnings, typically speaking, are going to compound over time. So this is generating that attractive and sustainable return that will generate the shareholder value. Now, compounding is something that I think we kind of throw around quite a bit, but how often do people actually think about how important compounding is? And I think we take it for granted because it's really in our lives from such a young age. Like, think about school, for example. Like, you learn something during the day, you go home and you do some homework, and the next day you build on that skill. That's compounding. Like, I used to do triathlons, and that power of compounding is so important. It's building that muscle memory. There's no way you'd go in and do a 12-hour race without having done the training, doing the practice, building. And it works exactly the same for a company. So when a company, they're generating revenue, generating profits, when they reinvest back in the business, they're building the strength of the business, which will then compound and lead to those greater returns. So it's really interesting in the values that that quality brings out. And I think the final thing to really bring out here is it enables you to invest through the cycle. Now, a quality company are those that have those more sustainable cash flows that we've mentioned, which means that when you have a downturn, they're more likely to perform through it. And we've really seen this in the latest cycle. Buy now, pay later companies are just one example, like your Zips and your Klarnas, and they've had a bit of a tougher time versus your incumbent fintechs like your Visa and Mastercard. And that's because the strength of their business isn't as strong. And they don't have as strong a customer network. They can't spend as much on customer acquisition, and they're not able to grow the way that they used to. And the share price has really reflected that. So quality is really important. It's something that as an investor, you should be thinking about and asking the question of, is this a quality company?
Yeah. So you mentioned the idea of the sustainability of earnings, and I'm glad you brought in the history of running triathlons. I find that with compounding in particular, that it's more that kind of the part where people tend to underestimate is kind of like the 5 to 10 year window of compounding. So people have a pretty good idea of like short-term compounding, and that's maybe relating to your buy now, pay later example. Like, they grew really fast in a very short period of time. But did they have staying power, which is where your idea of sustainability of earnings come in? So I'm just kind of curious how you think about like the length of compounding and how important that is.
Yeah, absolutely. So I think that's when you put those kind of 3 metrics that I mentioned there all together, that is really that ability to invest through the cycle, which gives you that power of compounding. Because, like, when you think about a strategy in a company, most strategies aren't about, well, what are we doing next week? It's how do we invest in the business over the long term? Well, when we're looking at a company, that's what we're looking for. It's how do you invest over the long term? And so you need to give time for that investment to actually play out. And Visa is a great example of that and how they've been able to achieve that over time. So if you look the last 10 years, Visa has, and I'm going to muddle the stats up a little bit, but it's just because they're so phenomenal in what they've been able to do. They've more than doubled the number of volumes that they process on their payment networks, and they've more than tripled the number of card users, and I think it's nearly triple in terms of the merchants. So that's not something that you could do over 1 year. Yes, the share price will improve over 1 year as like an increment of that, but it's the compounding on the compounding that has made Visa what it is today, which is that largest payment network that's able to innovate, withstand competition, and makes it the strength of business that it truly is. And I think it's about 19% annual returns that it's had over the last 10 years. And that's the power of compounding and that strength of the network that's just giving that perpetual flywheel.
That's really interesting. I love Visa as a case study, but also Mastercard and to an extent Amex as well. But I'm curious. Okay, so we've got this like quality framework that we're talking about. Yeah. Across the core series, across the funds that you run, they have a range of different sectors and industries embedded within the fund. But I'm curious, even when you identify these types of industries or companies, how do you go from, okay, payments seem really attractive. Like, how do you identify that in the first instance and then get down to, oh, well, Visa and Mastercard are a good expression of that. So like filtering the universe is basically where I'm kind of going, is like, how do you identify them?
Yeah, look, there is no short answer on filtering. It's we're not using like an historical data filter on how do we determine which company to invest in. A big part of it is that research DNA. So it's becoming an expert in the payments industry. We're understanding what's the industry makeup, what's the industry structure, who are the different participants, to then go down the funnel of, well, which companies should we actually be investing in within payments? Because you will have winners, you will have losers, you'll have those that are just like, yeah, they're doing an okay job. And it's not until you get into that nitty gritty and understand what the industry is until you can actually pick out who are likely to be those structural winners. So we spend a really long period of time when we're starting on a new industry doing that deep dive to understand, well, what company is likely to benefit from this structural growth tailwind. So yeah, like when you're looking at payments, like you think, well, okay, well, we're moving from cash to digital, so there's this rising boat. And yeah, everyone will win a little, but then you've got the Visa Mastercard opportunity where you can win a lot.
So I guess when you think about like the moat, which is a key input into the quality kind of spectrum, say like buy now, pay later companies, which seem like a bit of a fly by night kind of theme at the moment. How do you kind of determine that I guess the ecosystem overall, how did you determine that Visa and Mastercard were strong franchises where those buy now, pay later companies weren't? Like, how do you look at the competitive positioning in the industry?
Yeah, absolutely. So let's really step back and think about Visa and Mastercard and what makes them a high quality business. So just as a kind of bit of background, Visa and Mastercard, they're really, in our opinion, the only truly global open payment networks. They're in over 200 countries. In the case of Visa, it has close to 4 billion cards that use the network. It's got around 100 million merchants. Now, before we get into the fun technical stuff, which I'm sure you'll all enjoy, let's just think about our own consumer experience and how we use payment networks. And this really does feed into why we end up liking them. So you can use your card anywhere in the world with a Visa or a Mastercard. It's very simple. You tap it or you put your PIN in. It's this ubiquitous, fast payments experience that is basically enabled us to no longer need travelers checks, to no longer need to carry this wad of cash everywhere we go. It's just you're able to tap, you're able to go. You can use it online, you can use it in store, and then you have those fraud protections. Like, this is really impressive when you think of your own payments journey since we had that Dolomites account and then what's happened over time, your evolution with money. And I think it's safe to say Visa and Mastercard have actually been the backbone of that entire payments journey for everyone in the world, right? It's really impressive. So what have they actually done and how can we distill, well, what makes them quality? The first thing is network effects. This is like, I think the term perhaps even was introduced because of Visa and Mastercard. Like, they really are the foundation of what a network effect is. And what it means is that every participant benefits, and that means your consumer, your merchant, and Visa and MasterCard, they all benefit as the network grows. Right. So this is really important factor, and that's what's allowing for that compounding, because as the business grows, everyone benefits and the boat rises really well. The next part, I'd say the feature is the barriers to entry. And for Visa and MasterCard, they are extraordinarily high. Now, for the consumer, a payment's really easy, like we just spoke about. But the actual payments web is really, really complex. Because it's complex at the national level, but then you go to the global payments level, and then you have regulation on top of that. So when we're looking at the web that they're connecting, you have those billions of consumers, you have the millions of merchants, you're then connecting them to thousands of banks. Merchants all have acquirers that help them collect the electronic payments. So there are so many different angles here, which makes it really complex. And then on top of that is, what are they actually trying to achieve with respect to this payment? And it's to achieve that simplicity, Visa and MasterCard need to be able to authorize a transaction in seconds. So that's making sure that it's the right person that's trying to make the transaction and that's legitimate, but also that you have the right amount of funds. So it's not very simple what they're trying to do, and they've mastered it. They are able to, they do, like, I think it's about 60,000 transactions a second, Visa does, or more. So it's really impressive what they've been able to achieve, and no one's been able to replicate it. Why? It's really complex. And it's that power of the network effect, which makes the barriers really hard, because if someone new comes in, they've got to spend so much money to try and create that consumer and merchant experience that Visa and MasterCard already have. So why would you as a consumer pick the new payment option when your Visa and MasterCard to you is free? You just tap, go, everything works. You've got your consumer protections. Why would you try something else that may not be as good? And they've just got to spend so much money to do that. So competition isn't really there. You've had other networks like your buy now, pay laters. You've had crypto, try and think about it a little bit. But it's been really hard to create a competitive environment around payments. And that's partly because Visa and Mastercard have been really defending that economic moat through that continual innovation and driving the cash digitization. I think a point here that shouldn't go missing is like debit, for example. So you think about the Australian example here with FPOS. So probably 15 years ago, FPOS was a term that we actually would have used a lot, that, I'm using my FPOS card, blah, blah, blah. Like there was a debit network here. Visa and MasterCard with innovation came in with their debit rail that had through the chip. Now, how often now are you actually putting your PIN in? You're tapping. Now, it's more expensive for the merchant, but it's merchants, but that consumer experience and the speed in which you can transact it's making the competitive environment harder and harder, which just strengthens the moat, the resilience, and then those shareholder returns for Visa and MasterCard. And when you put all that together, they have scale. And Visa, would you believe, has the highest operating margins in the S&P 500. So that's the 500 largest US companies. Visa's number one with respect to its operating margins. And that's really that strength of moat that they have. And they're continually being able to defend that through innovation and execution on the strength of the product that they have.
I've got two questions around I'm very much of the opinion that these are wonderful businesses, but I always love to invert that and ask myself, what are the risks? So I guess the two things that come to mind for me through the lens of risk are, one, like government regulation, whether that's at the country level or whether it's like a bigger thing like international payments level. So regulation would be one bucket. And then the other one would be, I think you've already kind of crushed it a bit, which is like, do you think that like the blockchain system of payments, digitizing payments, is a genuine threat? So we've got regulation in one hand, and then we've got blockchain on the other.
Yeah. Oh, This is a great question. And I think you might want a job at Magellan, Owen. Like, this is exactly how we think about quality. And we're very focused on that downside protection. So risk, like while we're thinking about what's the opportunity, it's really about what could undo our thesis. So let's start on the blockchain one, because it was quite a fad, like less so now, about 5 years ago, about, well, how can blockchain disrupt all of fintech basically, and like everything, like blockchain's the world. Look, we're not concerned about blockchain. I think in terms of a technology that it will be used, that's basically a fancy way of calling it, it's that digitized database, essentially. So there will be use cases for it where it makes a lot of sense. But payments is unlikely to be that use case in the near term. Mentioned before the number of transactions that Visa can do, that over 60,000 per second. And that's how many that you need to be at that level for a global economy to run. Blockchain is doing around 10, I think we're probably up to now, per second. So you can't run a global economy on the pace that where the technology is for blockchain. It may get there in time, but it's not been a fast evolution so far. And then the other part is the importance of those safety protections. It shouldn't be underestimated, the strength of Visa and Mastercard that's linked to its ability to authorize transactions for the right person, and also protect merchants from fraud. There was a really good example in the US. So they developed a real-time payment network that was allowing peer-to-peer transactions. It's called Zelle. So all the banks got together and developed this network, and the fraud rates on there have just been incredibly high. It's not easy to do, and that's one of the competitive advantages of Visa and Mastercard, is that they're facilitating transactions globally. So they're working out, perhaps it's in London, that there's a particular kind of scam or fraud happening, and they're then able to use that across their whole network to prevent fraud. So it's a really important kind of feature that these companies have. But onto the risk that we are really concerned about, that is regulation, as you've mentioned. So payments are essential for day-to-day life, and for a functioning economy. So it's no surprise that the government is looking at payments with somewhat of a microscope. Now, when you're thinking about what the government's role is, one, they need to have a functioning payment system. They've benefited significantly from the digitization of payments, because you're moving transactions from a cash economy, which can be hidden, into a digital economy, which is harder to hide. So governments have benefited a lot from this, and you've seen India go through that big push on demonetization to try and drive their digital economy. So they do like Visa, Mastercard. So they're not fully against it. But the part that they don't like is that they don't have control over their payment system. These two large American companies, we're reliant on them. So there's that element, which we did see in Russia last year, where they turned the switch off. The politicians globally decided to say, well, no, you can't facilitate transactions. And that just really brought that debate up again of, well, we don't have power of our own payment system. So they're concerned about that. And the other thing that they're concerned about is competition. So we went through some of the factors before on why Visa and Mastercard are so strong. And that's those barriers to entry, and that competitors can't come in. It's so expensive for these competitors to come in and try and replicate the networks. They've tried, they've failed. And so now we're actually seeing governments build these competing networks to Visa and Mastercard. So there have been these real-time payment networks around for decades, but we're really starting to see governments think about it in a lot more detail on, well, how do we build our own network that can effectively compete with Visa and Mastercard? So we view that as a longer-term threat for Visa and Mastercard. It's something that we do a lot of work on. We read a lot of documents that come out from central banks. And a big part of that is that consumer proposition that we've kind of been talking about. And I suppose I should premise that it's the main threat here is on the debit network, not on the credit. The central banks that are building these networks, they're highly unlikely to get in the business of offering credit to consumers. So it'll be all about the functioning of the debit system and the risk that is to Visa and Mastercard.
I've got a question around this. So can you just define the key difference there? So like credit versus debit. So a lot of people know that they can just tap the button on the terminal or whatever. But what does that actually mean?
Yeah. So for the payment networks, it's virtually no different. There are differences. Payments, Visa and Mastercard do not offer credit. Their role is to facilitate a transaction between the consumer asked to buy, the merchant is selling something, and it's the transferring of funds from the consumer's bank to the merchant's bank. So when it's debit, you actually have the cash in your account. So Visa and Mastercard need to make sure that you have the money to give to the merchant. When it's credit, Visa and Mastercard are checking whether or not you haven't reached your credit limit, but it's the bank that is offering you that line of credit, not Visa and Mastercard. The very cool thing about their business is that they're not taking on the credit risk. They just clip the ticket on every transaction that comes through their network. So they're kind of like a bit of a railroad or a toll road for consumer payments.
So I've got one more question on payments before maybe we can move on to other quality industries and companies. But so those two risks put to bed, the blockchain and regulation, is there anything else that comes to mind? And maybe there isn't right now, but is there anything else that comes to mind for you that you think that's a risk that people probably should be aware of?
To be fair, regulation is the one that, like, if you're saying what keeps you up at night, it's monitoring what's happening with the real-time payments execution. Because a big part of that is, so it's not just build a network and they come. It's far from that. You need to develop this consumer experience, but you also almost need to force the usage, or the network that's built needs to be so good that it has those fraud protections, it has the ability to refund, it connects globally for people to want to switch, because the merchant wants you to switch because it's cheaper. And I think the reason why I'm bringing this up again is because you've said Brazil is a really interesting case study here, where they built their real-time payment network, but the government, central bank there, mandated that it was to be used. It mandated that banks implemented this. It mandated for merchants to start using this. So we got the take up. So that's the interesting thing. It's all about the implementation of it. We don't think in the US that the Fed is going to come in and be so draconian on how this must be used. It's slightly different economy, and it's unlikely. But they're doing their best to produce a product that has the opportunity to compete, but that's going to take some time. There was an update this week from a conference, and you need to get everyone connected. That's how these networks succeed, is when you have all the connection points, and that's going to be a 5 to 10 year journey.
Right. Well, that's good news for Visa and Mastercard shareholders for now. I'm curious, if we step back from payments for a little bit and we think we talk more about the quality aspect of your investing. I know there are quite a few companies that are included, particularly in the core series at Magellan. I'm curious, are there companies through that research that is done by the broader Magellan team and then eventually make their way into those core series funds? If there are industries or thematics, sectors, however you want to define it, that continually surface in terms of high quality and, durable moats and these types of things, are there industries or trends? And what I'm going for here is, if people are listening to this and they're looking for companies to buy in 2023 or even put on their watch list, what have been historically some of the more fruitful parts of the market? And conversely, maybe if you have an opinion, what has been?
Yeah, no, absolutely. It's a really good question. So I might just provide a little bit of backdrop on what the core series is to kind of frame it. So the core series is built on Magellan's DNA, which is essentially that definition of quality that we've spoken about, and then that approved list of companies. So when we're deciding, when we get to our approved list, it's that hard work that we've done in understanding each of the individual industries. So at each sector, we view there are quality companies, that you've got the good and the bad, or the winners and the losers, that will be there in each of the individual sectors. And that's because we're trying to identify, well, which ones have that favorable industry structure, those that customer advantage where the switching costs are really high, that the customer won't want to move over, or there's pricing power. So I suppose when we look at the index and where Magellan's approved list is perhaps overweight, so that they're the sectors that we really value highly versus others. The software sector, we're overweight versus the index. Consumer staples and consumer discretionary, they're three categories that we're very much overweight. And I'll kind of talk through, well, what is it about those sectors that we like? And then what we are underweight is in REITs, energy, and then on the healthcare side. Now, there are quality companies in each of the industries, but it's those attributes where we're looking for that sustainability of earnings, that there can be differences in industry structure or the consumer proposition that then means that one is perhaps has those higher quality attributes than the other. So maybe software is a really good example. So here we're looking for companies that have that strong customer relationship and awareness, but it also has that stickiness. So Microsoft, I think, is a really good example here, where probably everyone on the audience at some point has used Microsoft Office. And for us to switch to a different software provider, I think most would be happy to just pay more versus switching, right? Because we all know, we've all got our shortcuts in Excel, we know how to use PowerPoint, and it's that stickiness of the consumer combined with the strength of product that Microsoft, they continue to innovate, that keeps you in the ecosystem. I imagine most of us, when we were told to work from home, either the few weeks before or the few weeks after, Microsoft Teams just kind of pops up, right? So it's their ability to continue to innovate and keep you in their ecosystem that makes software a really sticky business and a high quality business. We've also mentioned consumer staples. So these are very similar to, these are products that we need to buy in our everyday lives. So we're thinking about our Nestle's or our Procter & Gamble. So we're always buying these products, but not all consumer staple companies are equal. So here we're looking for companies that have that strong industry positioning. So it's those top one or two brands within each of the different industry sectors. It's they're having that size and scale means that they can continue to reinvest, which means that they're able to meet those new consumer preferences, be it the change in preference towards non-dairy, for example. So it's that ability to change in a fashion that enables you to then continue to maintain that consumer basket. And it's that flywheel that Nestle and Procter & Gamble have that make them really valuable companies, because they're able to offer a range of products and high quality products consistently. They've got the scale, they've got the distribution. Not all consumer staples are equal. And so we do have a preference for them in the portfolios. Some that we don't invest in is energy. So we actually exclude energy companies from our approved universe. And a big part of that is we don't define them as quality. So their share price is moving primarily due to commodity price, which is not linked to that underlying sustainable business model. So they're just a few examples of ones that we like, ones that we don't like. But it's really looking at each of the individual sectors and finding that high quality company within the sector.
Yeah, I do really like that. It's like almost like there's no shortcut for like a true expression of quality. Like we try to find statistically, we could run a screen and say, well, of all companies in the United States over 5 billion market cap, what's been the average return on invested capital? Maybe that's a proxy for quality, but it doesn't have that forward-looking element which you're after, which really comes from like the hard and the soft, what I would call hard and the soft kind of, I guess, factors that go into investing, the quantitative and the qualitative. And so many people just rely too heavily on one at the expense of the other. There is a question that I've got here around risk, because you're not only, looking through the lens of like quality international, like global companies, you also spend a lot of your time thinking about ESG. And so I'm curious, and maybe this is a way to tie that in, how you think about risk, and maybe the way you might think about this is like, how do you think about it personally or at Magellan, however you want to frame that, against maybe what we're taught through academia? I know, you've got a PhD, you've studied this stuff for a very long time, so you're probably well placed to answer this question, even if it is a bit nuanced.
Yeah, so risk is I think there's a few lenses that you can look at risk from, and the first element is the I'll maybe call it the investing risk. So that's really, and we achieve that through defining the universe. So when you look at the investable universe, there's thousands of companies, but we bring that down to around 200 companies at Magellan, and that is through that definition of quality. So we're trying to weed out the companies that we don't think will be survivors. These are the companies that we think have that kind of 10, 20, 30-year trajectory. So we're trying to remove that element of risk in our portfolios. So universe, really important in that. But on the business risk side, this is a really interesting part, and it's the timing of it is very difficult. But when we're looking at business risk, we again have that forward-looking approach where we sit back and we look at a company, and there's several factors that we're looking at. There can be industry specific. So here we're looking at its exposure to macro, to geopolitics, but it can also be company specific. So some of the business risk that we see, and this is one of the things in tech companies, for example, is our ability to forecast. So if a company's disclosure, yes, it does meet all of the regulatory requirements, but if they don't give you a lot of granularity on that revenue line, then your ability to forecast and then have certainty on those revenues is quite low. So that's an element of business risk. So we actually break it down into the different layers of business risk, and then come up with a score essentially, so that when we're doing the portfolio allocation, we know what we're getting into, and we can weigh up the risk reward for each of the individual companies. But I think the important thing when you're thinking about business risk and the hat to put on is, how does this impact cash flows? How does it impact valuation? And ESG risk is a great example of when we're looking at risk, is that focus on materiality. ESG, there is like tens to hundreds of risks that companies could be exposed to, but it's really focusing on, well, what matters to the individual business. And that's how we frame it, and we keep coming back to on a day-to-day basis.
There is a kind of a bit of a fun question that I have, and it probably ties into this as well, because it maybe gives us an illustration of this. So if we just exclude payments, let's imagine they're not existing for a second. Is there a company that you can think of that you think that this is one of the best business models you've ever come across? Because then that might be an illustration of I guess a case study for people listening or watching who think, well, I can go and pull this apart and maybe see what the Magellan team saw in this myself. So that's kind of like a cheeky question of like, what's the best business model? So not necessarily an investment. We're not here for fishing for investment ideas or whatever, but more so the business itself.
Yeah. I think you frame that well. It is a cheeky question because we're in the business of investing in a portfolio. So we're looking for many great business models. And so it's really a big part. Well, one of the factors often is the industry structure that we're looking at. And so just some examples of that kind of quality business model. You could be looking at a regulated utility. So that in some jurisdictions, they are regulated in their earnings, but they're monopolies. So that's a really favourable industry structure, which then leads to a favourable business model. You've got ASML. It's a leading manufacturer of semiconductor lithography equipment, market share of over 80%. So again, a really favourable business model. But I think one that if we're going to talk about one and drill down into it a little bit more, I might talk to the index provider business model. So MSCI is a really good example of this business model. Their primary business is being index, but they also have these ancillary services that relate to analytics and then also sustainability and ESG. So What makes MSCI kind of unique and why we really like it is that index part of the business. And what's really cool about it is once you have an index, you need to turn it into a benchmark. And once you've done that, you're essentially a monopoly provider. All right, so let's just think about that a little bit. So it's basically a duopoly. So there's S&P that have indexes and MSCI. So in the US, S&P is the benchmark for the US market. Think about the S&P 500. But then on the global scale, MSCI is that benchmark through the MSCI World Index and then the MSCI Emerging Markets Index. So once you become a benchmark, all of the assets that are linked to it, be it through passive investing, be it through a fund manager that's benchmarked to a benchmark, they get a fee for that. So they're clipping the ticket on the growth in equity markets, the growth in debt markets, if they have a benchmark linked to it. So these are essentially monopolies in those individual benchmarks that they have created. They have pricing power, they have scale. They're really incredible businesses with respect to what they have created. And what's interesting is how sticky these businesses are. So as a fund manager, for example, once you've set your benchmark, it's really hard to change it. You'd actually need to go to each of your clients and say, well, we're changing our benchmark. And when you do that, you're forcing a conversation that begs the question of, well, why are you doing that? What's wrong with the current benchmark? So no one changes. Everyone stays with their current benchmark, and then MSCI or S&P benefit from that. They're also really scaled businesses, as I mentioned. So yes, you have that initial cost of setting up the business, but that every incremental dollar that comes through essentially drops to the bottom line. The margin for MSCI in their index business is over 70%. Wow. Like the economics are truly incredible for these businesses. So yeah, that's kind of just examples of an industry structure that we really like. We view these, that's a kind of the higher moat businesses. But the important part is that management execution as well. So we've spoken a lot about quality. But a big element of quality is also how are management executing against this? How are they making sure that they're defending against their moat? And that is that continual innovation that you need to be looking for in a business to make sure that they are defending their moat. Now, it can't just be capital allocation for the sake of capital allocation and just spending money to try and create a new product. It's building on the base that then leads to that compounding. So it's like a product that you can sell to your existing network that's value add. That's where you really get that compounding.
Yeah, I love that. That's one of the areas where I see a lot of investors, even if it's not in like established companies like we're talking about now, in like small or mid-cap companies, where there's like the variant perception comes from just even looking at like the segment lines of a business and looking at, well, they have this industry, they're awesome at this, but maybe they could do this. Yeah. And then they management identify that. And I think the key signal there is like those transcripts and those quarterly calls that management have where they say, well, we've tried this, like an MVP, like a minimum viable product in this adjacency, and it seems to be working. And I find that just as like a general rule, like a general kind of like rule of thumb is like, if you actually get down to that level of granularity, you can start to unearth some of these things.
Yeah. Yeah, no, it's a really good point. It's really important. Like when we're looking at a company, when they do an acquisition, often we like the bolt-on type ones. So like Visa and Mastercard are great examples of that, not to keep coming back to them, but they're companies that will buy like a software solution, for example. Like if they can see in the market that someone's doing a really good job on a particular fraud technology, they will buy that. They will then put it into their network and then they sell it to all of their customers because that will enhance the proposition for the individual customers. So that's an example of a really great acquisition where you can add it in. Nestle does the same thing. They often acquire new brands within the food and beverage space. And why it works when they pick the right brand is that they've got the distribution. They're able to like buy a new brand of biscuits or whatever it may be, and they've already got the distribution into Coles and Woolworths. They've already got the scale, and they can plug it straight in. Like, it's a really important part of their business. It's not like they're going and now they bought a business that's linked to hardware. Well, if that's not in their distribution network, then they've got to build that. So it's trying to really build within that circle of competence that will then enable the compounding and that flywheel to take hold.
No, I love that. I love that. So I've got a couple of questions left, but now I've got my icebreaker questions that happen to come at the end of the show. There are three of them that are quite a bit of fun. So I know you love food and travel and all these types of things, as well as, previously running triathlons and all of that. So the hard-hitting questions I've got for you are as follows. Where is the best food, I'll say food joint or like eatery in Sydney for under $50? I travel to Sydney regularly, so this is selfish of me. I am asking this for myself.
All right. Well, I like cookings, but I'm not good. I love the chat, but I'm not going to say that. Okay. So I would say the place called Bart Jr. It's in Redfern. They have an amazing, so if you want to really keep it to under 50, their family night on Tuesday is phenomenal. They will cook you homemade pastas with amazing sauces, fresh ingredients, definitely like made with passion. So that would be my tip.
Okay. I like I said, this is purely for me. I've got my notepad and pen right here, so I just wrote that down. So who does better coffee, Melbourne or Italy?
See, this one is tough. I'm Italian. However, I do like milky coffee. So if I'm drinking milky coffee, it's Melbourne. If I want a black coffee, I think the Italians definitely do it better.
Okay. This is going to be the nightly news over in Italy and Rome. This will be making headlines.
My cousins won't be very happy. They won't be surprised, but they won't be happy.
Okay, last question, and this is to tie it into investing, is what's the best food-related business? Now, I would say you're free to take off your ESG hat here and just say, if it's junk food, it's junk food, but you answer this however you want to. I'm just curious, what's the best food-related business that you've come across?
Yeah, I think, we'll bring ESG in because, as we mentioned, ESG is really important to talk about for all businesses because it impacts their cash flows. May not be a risk today, but over the future, it's definitely really important. So we'll bring that back in. But I think the restaurant companies, so that's your McDonald's, that's your Yum Brands. These are really interesting companies, and in our opinion, they're very high quality. So they've been set up as a franchise model. So what that means is that they license essentially the use of their brand. The franchisee will benefit from being part of the larger business. But McDonald's and Yum take a percentage of every transaction. They also have pricing power. So this is really important, especially as we've seen the last 2 years in the inflationary environment, that they've been able to clip the ticket on every transaction. But importantly, they've got some wage inflation. Obviously, there's people at head office that are running the business, but they're not linked to all the employees at the individual restaurants. So that protects them a little bit. But they also have scale. So this gives them that competitive advantage when it comes to sourcing. So really important to get the right ingredients consistently and at the right price, which then enables them to deliver that consistency in product that these fast food, quick service restaurants are known for. Now, you did mention ESG, so be remiss of me as an ESG analyst not to talk about it. ESG risks are part of every business. So I think it's important for all of us to take off that hat of, McDonald's is in fast food, the food isn't healthy, it mustn't be investable from an ESG lens. Quite the contrary. So McDonald's is actually, as the largest restaurant, it has a lot of opportunity to drive changes, be it with healthy habits, be it with packaging, that then have such a great influence around the world. So some of the small things they do is when you're going onto the online order, not going to the person, when they're bringing you beverages, for example, they put the diet drinks and the water at the top of the list, because people aren't as likely to scroll down. So just a small change like that, people will be picking a healthier option. They've also moved to having salads, to having grilled. So they're offering options that are enabling them to appeal to all consumers. And they're also focused on reducing the salt, the sugar in all of their products. and they're investing in that so it doesn't impact the quality. I think a really interesting one for them, let's on the packaging side, is the French regulators have put in a rule that if someone's eating in store, you cannot use any disposable packaging. So that's meaning they have to move back to plates, move back to forks. They've even got this like plastic red little bucket that your chips come in. But what's cool about this is that McDonald's have invested in their French business to enable that more sustainable dine-in option, which then means in time they're able to roll that out around the world. So just think of the amount of packaging and that investment that they're doing that will then have that cascading effect throughout their entire business. So there are things they can do better, but absolutely they're investing to try and drive change and have that positive footprint and improve their cash flows in the future.
I did not know that about the putting the healthy stuff at the top of the automated ordering thing. That makes a lot of sense though, because I do see it every time it pops up. One thing I did remember every time I've been to Macca's over the last little while is everywhere I go, basically, Macca's has run out of Coke no sugar. It's just like people have made that complete switch to Coke no sugar, which is a good thing. I'd assume over time. And I love these examples because I think it's a delicate balance in franchising. Like they say that the best way to get rich is to use someone else's money to do it, and franchisees do that, for these networks. And the key point is that they've made it sustainable. So throughout all levels of that ecosystem, whereas some businesses, like here in Australia, we have like Gloria Jeans, which was owned by Retail Food Group, which was clearly, there was way too much pressure on a kind of weak stack on that network, and that fell apart pretty quickly. So I do really like this, and I can see that it's in the top holdings. At least McDonald's is in the international core series fund. So I will direct people, anyone listening to this, to go online and to check out the landing page for the core series funds. It's the three funds, but in particular the international fund. If you want to see that list that I'm talking about, I'll put links in the show notes to that, so we don't need to worry about any of that. Just check that out. I think it's a great resource, and I think the team you're putting together and the funds are a great resource for anyone to look at if they're looking at, well, how do I even think about identifying these companies in the whole universe of companies throughout the world? Who has done the work? Well, Magellan's team's done the work. And so you can go and you can look at these companies and read about them and so on and so forth. But the final question I might throw in is my little one to end the show, which is what's one thing you believe about finance, business, or investing that few people would agree with you on?
I'm glad you gave me this one in advance, because I really thought about like what is the right way, what is at that point. And I think the conclusion I got to is a lot of people think about what I'm about to tell you, but it's how we actually execute on it that I think we could improve on. So that really is to look through the noise and be patient. It's not necessarily an easy thing to do, but I think coming back to Visa again, sorry to be the broken record on this, but it's a really interesting way to think about it through this example. So you might have known that in 2021, Amazon was trying to threaten Visa and remove it as a payment method. They started out with the UK, Singapore, and Australia. So it was really this battle of Goliath versus Goliath. You had the largest payment network versus the largest e-commerce business. Now, there was a lot of noise at the time. Like every week or second week, there was a new news article that was coming out about the power that Amazon has. Amazon's going to, it's threatening Visa. Visa's economics are going to be in trouble. Now, there's an element of maybe that could have happened, but I think when you step back and you think about, well, why is it that I like Visa? And it's the strength of the network. It's that consumer experience that's really important, right? So despite all the noise and Amazon trying its best to switch people, and they were incentivizing. I think in the UK, they gave people £20 to actually put in a new payment method, right? But in the end, they worked things out, and I believe Visa is the winner in this scenario, and that's because Amazon needs Visa, right? If that is your payment method that you choose to use, where you have the fraud protections, people don't want to switch. They use that card everywhere. So Amazon, whilst being the largest e-commerce provider, doesn't have the power to say, you consumer, you can't use this payment method anymore. So the reason why I bring that in, this kind of be patient and avoid the noise, is if you've done the work and you have conviction in this business, in the case of Visa, that the strength of its network effect, it's be patient, because it actually presents a buying opportunity or a time to top up, in our case, that then leads to those strong shareholder returns.
I love that example. And I'm glad you brought up that, because it was like at the time, it was perceived as a true threat to Visa's business model. And if Amazon can't do it, well, then who else can, is, I guess, the question. So if Amazon's knocking on your castle door and you've got the moat surrounding it and they can't get across, like they're trying to get in, and they can't, then I think that says something about the business model. So now this has been heaps of fun. I mean, there's so many takeaways. I've got my notepad here. It's already full, this whole page. So I really appreciate you taking the time to join me on the show today.
No, thanks, Owen. It was really great to chat.